What if I told you that most of the money in your bank account didn't exist until someone borrowed it? It sounds impossible. After all, we've been taught the same thing since we were children. Money is printed by the government, it's produced by the central bank, and then it enters the economy. Simple. At least, that's what most of us believe. But what if I told you that this isn't how the modern financial system actually works? What if the money you receive is your salary? The money you use to buy groceries? The money sitting quietly in your savings account wasn't created by a printing press at all? What if it came into existence the exact moment someone signed a loan agreement? It sounds unbelievable. Yet this is one of the least understood truths about modern money. Every single day, millions of dollars, euros, pounds, and yen appear inside the global financial system, not because trucks deliver freshly printed banknotes to banks, but because something far more fascinating is happening behind the scenes. And here's where the story becomes even stranger. If creating money were as easy as pressing a button, why isn't everyone rich? Why do economic crises still happen? Why does inflation destroy people's savings? And perhaps the biggest mystery of all, if money can simply be created, why do governments still borrow trillions of dollars every year? The answer takes us inside a financial system that most people use every day, but very few truly understand, because once you discover who really creates money, you'll never look at your bank account the same way again. Before we answer the question of who really creates money, we need to clear up one of the biggest misconceptions about the modern financial system. Ask almost anyone where money comes from, and you'll probably hear the same answer. The government prints it. It's an idea we've seen countless times in movies, documentaries, and even political debates. Whenever there's a financial crisis, people imagine giant printing presses running day and night, producing endless stacks of brand new banknotes. It seems logical. After all, every banknote carries the name of a central bank, so it must be the central bank that's creating all the money, right? Not exactly. Here's something that surprises most people. The cash in your wallet is only a tiny fraction of all the money that exists today. In fact, in most modern economies, physical cash represents only a small percentage of the total money in circulation. The vast majority of money doesn't exist as paper bills or metal coins. It exists as digital numbers. Numbers stored in computers. Numbers moving between bank accounts every second. Numbers that can cross continents in less time than it takes to blink. So if most money isn't printed, then where does it come from? This is where the story becomes far more interesting than most people imagine, because the institutions we usually think of as money printers have a very different role. Central banks certainly play an essential part in the financial system. They issue physical banknotes, they influence interest rates, they help keep the banking system stable. But they are not creating every dollar, euro, or pound that appears in people's bank accounts. In fact, the biggest source of new money is hidden in plain sight. It's something millions of people use every single day without realizing what's happening behind the scenes. Every time someone applies for a mortgage, finances a new car, or takes out a business loan, the financial system does something remarkable. It doesn't simply move existing money from one place to another. Under the right conditions, it creates new money. That sounds almost impossible. But that's exactly how much of the modern banking system works, and once you see it happen, you'll understand why money today is very different from the gold coins people once carried in their pockets. So, if most money isn't printed by the government, where does it actually come from? The answer is both surprising and a little strange. Let's imagine you're about to buy your first home. You walk into a bank and apply for a mortgage worth $300,000. Now here's the question. Do you think the bank goes into a giant vault, takes out someone else's savings, and hands that money to you? Most people would say yes. It sounds reasonable. After all, that's how we imagine banks work. People deposit money, the bank keeps it safe, and then lends that same money to someone else. Simple. But the reality is much more fascinating. In today's financial system, that's usually not what happens. Once your loan is approved, the bank doesn't wheel out stacks of cash from a vault. Instead, something happens in just a few seconds. The bank types numbers into its computer system. Suddenly, your account shows a balance of $300,000. Yesterday, that money wasn't in your account. Today, it is. No truck delivered it. No printing press produced it overnight. It simply appeared as a new bank deposit. In other words, the loan didn't just give you access to money. The loan created new money. At first, that sounds almost unbelievable. But think about your own life. Have you ever financed a car, taken out a mortgage, used a business loan to start a company, or even borrowed money with a credit line? If so, you've already seen this process in action. Without realizing it, you became part of the way modern money is created. Of course, this doesn't mean banks can create unlimited money whenever they want. They operate under strict regulations. They must hold reserves, meet capital requirements, manage risk, and follow the rules set by central banks and financial regulators. But here's the remarkable part. In the modern economy, much of the money we use every day comes into existence when banks make loans, and something equally important happens when those loans are repaid. The money created through that loan gradually disappears from the financial system. It's almost like money is constantly being created and destroyed every single day. Which leads us to another important question. If new money is being created all the time, why doesn't everything become more expensive overnight? To answer that, we need to understand one of the most misunderstood forces in economics: inflation. Now that we know new money can enter the economy through lending, another question naturally comes to mind. If new money is being created every day, why doesn't everyone simply become richer? It sounds like the perfect solution. Need more money, just create more. No more poverty. No more financial problems. No more economic crises. If only it were that simple. Imagine a small village with just one bakery. Every morning the baker makes 100 loaves of bread. Now imagine that overnight, everyone in the village suddenly has twice as much money in their bank account. At first that sounds like wonderful news. People feel wealthier. They rush to the bakery, ready to buy more bread than ever before. But there's one problem. The baker still has only 100 loaves. The amount of bread hasn't changed. Only the amount of money has. So what happens next? The baker raises the price. Not because the bread has become better, not because it's bigger, but because more people are competing to buy the same limited supply. This is the basic idea behind inflation. When the amount of money grows much faster than the amount of goods and services available, prices begin to rise. In other words, it's not always that things become more valuable. Sometimes it's the money that becomes less valuable. History has shown us this lesson many times. In the early 1920s, Germany experienced one of the worst episodes of hyperinflation ever recorded. Prices rose so quickly that workers were often paid more than once a day, rushing to spend their wages before they lost even more value. Decades later, countries like Zimbabwe and Venezuela faced similar crises. As confidence in their currencies collapsed and the supply of money grew far beyond what their economies could support, everyday prices soared and people's savings rapidly lost purchasing power. These examples remind us of something important. Money only works when people trust that it will continue to hold its value. If that trust begins to disappear, the entire system starts to shake. That's why creating money isn't simply a matter of pressing a button. Every new dollar, euro, or yen has consequences, and that's exactly why central banks spend so much time trying to balance economic growth with price stability. Because once inflation begins to spiral out of control, it's incredibly difficult to stop. Which brings us to another question. If creating too much money is so dangerous, what prevents governments and banks from creating unlimited amounts whenever they want? At this point, you might be thinking, if creating money is possible, then why don't governments simply create enough money to make everyone rich? It's a fair question. In fact, it's probably one of the most common questions people ask about economics. And on the surface, it sounds like a simple solution. Need more hospitals? Create more money. Need better schools? Create more money. Need to eliminate poverty? Create more money. So, what's stopping us? The answer is surprisingly simple. Trust. Remember what we discovered in the previous episode. Money isn't valuable because it's made of paper. It isn't valuable because it's backed by gold. Today, money has value because people believe it will still have value tomorrow. That belief is the foundation of the entire financial system. If people suddenly began to think that governments could create unlimited amounts of money whenever they wanted, confidence in the currency would quickly begin to disappear. People would spend their money faster. Businesses would raise prices to protect themselves. Investors would move their money into other currencies, gold or other assets they believed would hold their value. And before long, inflation could turn into something far more dangerous. This is why creating money isn't just about a printing press. It's about maintaining confidence. Modern central banks constantly face a delicate balancing act. Create too little money and businesses struggle to grow. Unemployment can rise and the economy may slow down. Create too much and inflation begins to erode the purchasing power of every paycheck, every pension, and every family savings. Finding the right balance is one of the most difficult jobs in the modern economy, because money only works when people trust the system behind it. But even after understanding all of this, one mystery still remains: if governments have central banks, if banks can help create new money through lending, and if the financial system already has the ability to expand the money supply. Why do governments still borrow trillions of dollars from investors every single year? At first glance, it doesn't seem to make any sense, but once you understand the answer, you'll understand why almost every country on Earth is in debt, and that's exactly where our story goes next. So let's take a step back and look at the bigger picture. For a long time, many of us believed that money simply came from printing presses, that governments created it, that banks merely stored it. But as we've discovered today, the story is far more fascinating than that. Most of the money we use every day doesn't exist as paper or coins. It exists as digital numbers. Numbers that often come into existence when banks make loans. And just as surprisingly, much of that money disappears again as those loans are repaid. It's a system that has helped finance homes, businesses, innovation, and economic growth for generations. But it's also a system built on something surprisingly fragile: trust. Because without trust, money is just paper. Without trust, a number on a screen is just another number. Every paycheck you receive, every payment you make, every balance you see in your bank account only has value because millions of people continue to believe in the same system, and perhaps that's the most remarkable part of all. The modern economy isn't held together by gold. It isn't held together by printing presses. It's held together by confidence. Confidence that tomorrow the money in your pocket will still buy what it buys today. But if you've been paying close attention, one question still doesn't have an answer. If new money can be created through the banking system, and if central banks have powerful tools to influence the economy, why do governments still borrow enormous amounts of money every single year? Why does the United States issue treasury bonds? Why does Japan continue to borrow? Why do countries across Europe, Asia, and the rest of the world all carry national debt? Who are they borrowing from, and why not simply create the money instead? The answer reveals one of the biggest mysteries in the history of modern finance, and it's a story that affects every taxpayer, every investor, and every person who uses money. In our next episode, we'll uncover the truth behind government debt, who really lends money to countries, and why nearly every nation on Earth owes more money today than at any other point in history. Because once you understand who creates money, the next question becomes impossible to ignore: who owns the world's debt? I'll see you in the next episode.